Hey everybody. Okay, so welcome to Who Doesn't Love Depreciation. My name is Tamika Marie, and I am the owner of Team Tax and Associates. And tonight I am going to be covering depreciation. And I'll be the first one to admit when I first learned taxes, I was very intimidated by depreciation. I didn't necessarily understand why a house was depreciated over 27.5 years as opposed to a car. I didn't understand why you could depreciate a house as opposed to not being able to depreciate land until I actually started researching for myself and broke it down. The tax course that I took left a lot to be desired. So, with that being said, I'm trying to see if I can fix this background really quickly because I hated it. Let's see. I can't. All right. Well, background is what it is. So, who doesn't love depreciation? Well, about 10 years ago, that was Tamika Marie until I actually delved into real estate as my main niche for accounting. And then I loved to, I learned to love depreciation because there are a lot of hidden gems in there for being able to save your clients money. So let's jump into it. Tonight, we'll be discussing depreciation and how it can maximize the deductions and get the most out of your client's investment. So, what exactly is depreciation and how it can help you with your taxable, maximize your tax deductions? All right, so depreciation is an annual deduction that allows taxpayers to recover the cost of their basis of their business assets or investment property over a number of years. And the number of years is going to differ depending on the type of property. Depreciation is a powerful tool that can help you save money and get the most out of your investment by lowering your tax liability, is what it's doing. By understanding depreciation, you can take advantage of tax benefits it offers and make it basically makes your money work harder because it's money that's already spent. So that's the benefit in being able to recapture depreciation. Whether you're buying a car, a home, or any other asset, depreciation can help you get the most out of your money. You're going to get the most of the bang for your buck because again, it's money that's already been spent and invested into the business and or the asset. So now, how does appreciation help you save money and get the most out of your investment is going to be the objective of what we're talking about tonight. So recognizing what your depreciation begins and ends, right? So depreciation begins the moment that you place something into service. So there we go. It's also described when an asset cannot be depreciated. So it's very important to know when we can and when we can't depreciate things. And finally, we'll be able to identify which method of depreciation to use for a certain type of asset. And by the end of this webinar, you'll be able to better have an understanding of depreciation and how it can help you maximize your deductions. So jumping right on into it, it's important to understand when depreciation begins and ends in order to take full advantage of the tax benefits that it's going to offer you. So depreciation basically begins when you put the product or the property in service. So say for example, you buy a car. If you buy that car on January 1st, but you don't start physically using it in the business until February 1st, then depreciation starts on February 1st. So it's when you actually start to use the asset. So that means that the asset must be used for a specific purpose and it must be in service for a certain amount of time before it can be depreciated. So, for example, similarly, if you buy a building and you want to read it out, depreciation won't begin until the building is ready. It doesn't count when it's being rehabbed. So that's why if you watch flipping shows where people are on, they're always in a rush in that timeline because all of the money that they're sinking into that asset cannot be recouped one until they sell, and you can't even depreciate the assets that you put into it until you're actually ready to rent that out for you to be able to start recapturing that deduction. So depreciation ends when the cost of the asset has been fully recovered or when the asset has been retired from service, whichever one comes first. So if it's a house and it's depreciated over 27.5 years, once you reach that 27.5, there's no more depreciation for you to do. Another thing that I like to explain to people is depreciation is recaptured, period, point blank. So it is always best to depreciate the assets for your clients if they've got a business and they're putting them into service because when you go to sell that house, you're gonna, it's captured no matter what. Excuse me. Sorry about that. Alrighty, next slide. Let's see here. Where are we at? There we go. We caught up. Okay. What are other assets that can be depreciated? Well, for example, we're going to be looking at tangible properties such as buildings, vehicles, machinery, furniture, equipment, and storage facilities. All of that can be depreciated. We're also looking at intangible assets such as copyrights, patents, trademarks, and a computer software with a life value that is more than 1 year can all be depreciated. So, for example, your tax software investment, mhm, you can use it for more than 1 year, even though it's pretty much valid, for 2023. If you're a professional tax professional, oh, look, we got chats. Hey. Oh, you're welcome, Michael. If you've got chats, excuse me, if you've got your tax software, we're going to continue to use it. You know what I mean? We move into 2023 next year, and we know that we're filing back taxes. We're also in the process of filing amendments, so it is something that you can definitely write off. Okay. I always get nervous when people talk to me on my live because then I realize that I'm not just talking to myself. Always better when I feel like I'm just talking to myself and then I can't see you guys. But I feel like you guys want the camera on so you can see my face. I'm just giving you guys this information. All right. So now, what are properties that cannot be depreciated? Okay, so my presentation says properties, but let's not think of just properties. Think of assets. It means that to qualify for the depreciation under the tax laws, this could be because it's not considered an asset for tax purposes. Examples of assets that cannot be depreciated are going to include land. Why? Because land does not depreciate. It just doesn't. Property placed in service and disposed of in the same year. So if you purchase something and you do a short-term flip, there's no way for you to depreciate that. We always recommend that you put it into a 1031 exchange. I don't know if you guys saw the post, but that is like the sexiest thing that someone can say to me when it comes to taxes and real estate. All right, equipment used to build capital improvements, such as buildings or roads, cannot be depreciated. Capital improvements are assets that increase the value of the property, cannot be depreciated. Equipment used to build these improvements is not considered an asset for tax purposes. Therefore, it also cannot be depreciated. Okay, so Section 179 intangibles that must be amortized. So these are certain types of intangible assets that must be amortized over their useful life. Examples of Section 197 Section 179 intangibles include right-based, such as licenses, permits, trademarks, trade names, franchises, and non-compete covenants. Information-based intangibles like customer lists, formulas, and processes, internal training manuals, and other proprietary information. So all of your IP. These intangibles must be amortized over the useful life, for which is usually longer than 1 year. So for people who build their courses or for people who write ebooks and all of that good stuff, something that can be regenerated, those will be amortized. All right. Amortization is similar to depreciation, but it is used for intangible assets rather than for tangible assets and certain term interest in inventory. All right. Let's see here. What else we got? Look, okay, so I'm kind of flying through these tonight. I'm getting better as I go along. Certain term interest inventory, such as bonds, certificates of deposits, cannot depreciation. These investments are considered temporary investments, right? So even though you can hang on to a bond, longer than some of our mamas been alive, it still does not depreciate. Meaning they're held for a relatively short period of time and they're not considered an asset. Inventory cannot be depreciated because it is considered a current asset because inventory is expected to be sold or used within a year. Ideally, no one's supposed to be sitting on stock. All right, so now let's talk about the methods of depreciation. This is where I always got confused and it was an issue for me. So modified accelerated cost recovery system, which is also known as MACRE, and then we have the straight line method. These are the two methods of depreciation. Right. So the cost make for makers, the cost of an asset is spread out over its useful life, and the amount of depreciation is taken in any given year based on the asset's useful life. So if you purchase your cell phone, for example, the purchase of that cell phone can depreciate it over 5 years. We know that when you run out and you buy Apple every 2 or 3 years, they come out with a new model, and the moment that they come out with a new model and hit us with an update, our stuff don't work no more. Well, we still have the ability to depreciate that over 5 years. And Makers is designed to accelerate the depreciation of an asset such as buildings, machinery, computers, furniture, and vehicles because it wants the business owner to be able to recapture that expense. All right, now with the straight line method, excuse me guys, just a second, I'm going to sneeze, camera off. Sorry, if you guys have never heard me speak, it is loud, it is obnoxious, it would definitely hurt your ears. Okay, so with the straight line method, it's the simplest and most commonly used method that spreads the most cost of an asset evenly over its useful life. You're going to get the same amount of depreciation each year, no matter what. I think I should mention that with makers with the accelerated depreciation, you kind of get the most of it within the first year. Makers is a more generous than the straight line method and allows businesses to take large deductions in the early years of the asset's useful life. So generally, when you go to purchase your car, a lot of people like to do the 179 makers because it gives them a nice lump sum of a tax of a reduction in their tax liability within that first year. I should also state that a lot of people think that what happens with depreciation is it reduces your tax liability, which can increase your refund, but it is not a refundable credit in any way, shape, or form. Right? So makers cannot be used in the following situations. Let me catch up with my screen here. All right. So following situations that makers cannot be used in. Property placed in service before 1987. If the property was placed in service before then, unless the taxpayer elected to use makers after July 31st, 1986, it must use the ACRS or the straight line method. Property owned or used in 1986. Intangible property, films, videotapes, and recordings. Certain corporate or partnership property that was acquired in a non-taxable transfer, and property that has been elected to be excluded from makers cannot be used with that depreciation method. All right. So now let's jump into the straight line method, and we'll be wrapping up here pretty soon. This was such an easy one. Alrighty. So as I was saying, straight line method allows the taxpayer to deduct the same amount each year over the useful life of the property. And to determine the deduction, first you have to determine the adjusted basis, the salvage value, and the estimated useful life of the property. All right. So you're going to subtract the salvage value, if any, from the adjusted basis. The balance is the depreciation that can be taken for the property. You're going to divide that balance by the number of years in a useful life. This is the yearly depreciation deduction, and it's going to remain consistent during the entire time that you're depreciating. To use the straight line method and prorate the depreciation deduction by dividing the value proportionately based on a unit of time or a number of months. Now, you're not expected to know what the number of months is. There's actually like a little cheat sheet that I'm going to make sure that we put into the guide. And I also noticed, by the way, guys, that we've been just so overwhelmed with onboarding. So I haven't updated my guides for the last two classes, but I do have my client relations team working on that. So be a little bit patient with me, and we'll make sure that we get. I think we did due diligence, and then we did business formation. We're gonna get those guides up, and then this guide will be up probably sometime early next week. Just want to make sure we go in order for those who attended the last class. All right. So to use the straight line method, probably. Oh nope, I already talked about that. All right, so tangible property. So tangible property refers to any physical material item that has value and can be owned, such as real estate, personal property, and or merchandise. Now, it can be depreciated using either the straight line method or the maker's method. It has two parts: real property and personal property. Real property refers to real estate and any interest in land, including buildings, structures, and other permanent developments. Now, while personal property includes all tangible and movable items that have value and can be owned, such as vehicles, furniture, jewelry, clothing, or even electronics, it can be bought and sold, traded, or even given away, and its value is determined by factors such as its age, condition, and its market demand, right? So you're not going to be able to depreciate a VCR for the value that you purchased it for just because it's vintage, unless it is vintage, right? It would go by the value, but its use factor is kind of obsolete. So you'll want to make sure that you're checking into that when you're going into depreciation. Client relations team has up the researchable parts for the tax book, so be sure to get them up if you have questions in regards to what can be depreciated. All right, so intangible property refers to, or I should say, the years. What's going to be applicable for the years of depreciation, the lifetime. So intangible property refers to non-physical assets that have value, such as patents, trademarks, copyrights, trade secrets, and intellectual property. It's not something that can be touched or held, but it still has value, and it can be bought, sold, or licensed and otherwise transferred. Think of the white labeling services that I offer as an intangible property or a copyright or any intellectual property that you come up with, like your branding ideas and stuff like that nature. All right, so generally it can be depreciated using the straight line method, and taxpayers may choose to depreciate intangible property by using the income forecast method. All right, so for the income forecast method, I'm really not going to jump into that today, but you can look at publication 946 for more information. Right, roads, Lord. All right. So depreciation is a method of accounting for the cost of tangible assets over their useful lives. Depreciation is important for both individual and businesses as it affects financial statements, tax liabilities, and the overall financial planning. There are several methods of calculating depreciation, including the straight line method, the MAKERS, which is the modified accelerated cost recovery system. You know the IRS loves their acronyms. We don't play with them. And these methods used will depend on the specific circumstances and tax laws of each jurisdiction. All right, so where are we now? Those are the takeaways. I don't know if there's many people in here and if there are any questions, but as always, please continue the conversation directly in the Tax and Revenue Institute group. I'm going to get this information up in the guide, and it will be available for viewing for anyone who is a member of the group by Monday. I'm backdating my guides that I did for business formation and then also for due diligence for you guys. And so just be patient with me. It is 8:23, and I'm going to get ready and sign off. You guys have an amazing evening. Thank you so much for tuning in. Oh, and for those who are not members of the group, you can also catch this on our YouTube channel. Thank you so much. As always, you guys take care of you and take care of yours. Bye.